right, joining me now is Michael Reinking, Senior Market Strategist for the NYSE. I'm so glad to have you on the show today after we saw that big sell-off yesterday. We are seeing some green arrows today. What sense are you getting from investors about the pace of the sell-off that we saw yesterday, and what's going to happen from here? Was it a one-off, or is this sort of going to be the short-term trend?
Yeah, so I mean, yesterday's sell-off, I think, was like a confluence of events, right? Which kind of really started last week when we had the BOJ, kind of raise interest rates a little bit earlier than markets had expected, and then we capped off the week with some weaker than expected economic data. We did see some pretty significant weakness coming out of Asia, kind of over the weekend, right? And that really, it seems that we're kind of much of what's happening is kind of an unwind of positioning, right? As opposed to, I think, like a real scare about a recession or anything of that nature, right? So kind of the first point of that is being kind of, and the epicenter of that is coming out of the yen carry trade. So for many years and many decades, right, investors have been able to kind of fund, kind of positions using, kind of the yen as a funding instrument, right, to buy higher yielding assets and things of that nature. And then, kind of as those investors have started to unwind, right, and after many decades, they've kind of went out on the risk curve, right? So not only using that to fund, kind of treasury markets, but they've, kind of expanded to kind of cryptocurrencies and equity markets, right? And so you saw a pretty big unwind of that yesterday. Now, at the open, we saw kind of the VIX hit about 65. We backed off to the low 30s, by the end of the day. For viewers, what that suggests is that we're going to see about a 2% move on any given day, and about a 4 to 5% move on a weekly basis, right? So I would expect to continue to see some volatility here in the near term.
As we're seeing now, the market opened in the green. It's now turned red. I'm talking about the Dow. We can't ignore the data, though. You mentioned that you don't see this necessarily as a recession, but we did see the ISM data show contraction. We did see a disappointment in the jobs report, to mention just two there. I mean, how can we interpret those?
Yes. So, I mean, as I've been sort of talking about, kind of in our daily and weekly notes, we have seen signs that the economy is slowing, right? And so, this was a continuation of that. Last week we saw the initial claims data jump, up to almost 250,000. We had the weak ISM manufacturing, and then Friday's jobs report came in below expectations at about 100,000 jobs, and with the unemployment rate ticking up. Now, within that report, right, there are a couple of things that I'd highlight, right? A, there's some seasonal adjustments that are in question, right? We also have some weather, weather-based adjustments, given the hurricanes last year. And then in terms of the unemployment rate, right, that did move higher, partially due to the fact that we had the labor participation rate moving higher, right? So there are actually some, kind of positive reasons for the, kind of that unemployment rate to tick higher. What that has done is it did trigger kind of this SOM rule, which suggests that we're at the beginning of a recession. But once again, like it's why that unemployment rate is moving higher is pretty important. And what we saw yesterday was markets, and there was some fodder that we would start to see here the Federal Reserve kind of come in with an emergency rate cut potentially as early as this week. All right, that made absolutely no sense to me whatsoever. Right. The data that we saw last week does not suggest that we're kind of heading into a recession or at a recession point. Yesterday's ISM services, right, also kind of helped stabilize markets because that came in better than expected, right? So what I think we have done is more squarely put the potential of a 50 basis point rate cut on the table for the September timeframe. But unless things get significantly worse between now and then, right, I'm not expecting to hear anything different from the Fed.
So are you saying investors are pricing in that 50 basis rate cut in September?
Yeah, I mean, so markets have started to price that in, right? We're, it's not quite at 100%. I think at points yesterday we were priced in at 100%. Look, it's going to be dependent on the data as we move forward, right? We're going to see two more labor market reports. We're going to get the inflation data, right? And so, the Federal Reserve with the, if you look back at their summary of economic projections, right, that they just gave us, in June, right, they were looking for the unemployment rate to be at 4%. We're already at 4.3%, right? So, right, that gives them, plenty of space to cut by 50 basis points.
Okay, with all the activity going on in the market, we forgot that we're in the midst of earnings season, right?
Yes.
What have investors been taking away from the figures over the past few weeks?
Yeah, so in terms of earnings, right, the bottom line numbers have come in pretty good. What I would kind of highlight, and it's been a big theme that I talked about in our preview, is that we're seeing those bottom line numbers hold up partially due to the fact that companies have kind of instituted these kind of cost-cutting and efficiency measures over the last few quarters, we are seeing some top-line weakness, right? And so, with that top-line weakness, we're not seeing kind of companies necessarily being rewarded for that bottom-line beat, if they're missing on the revenue side of things.
Michael Reinking, always so great to get your expertise, especially on these volatile market days. Appreciate it.
Thanks for having me.
Okay.